Okay, we're going to begin now. This is the beginning of the seminar that is given by Kenneth Guilfoyle, CPA, and we're going to begin that in a minute. I'm going to introduce Ken in a minute. Before we do that, I'd like to just say that this seminar is sponsored by Republicans Overseas, and Republicans Overseas is a nonprofit organization, and we are affiliated with the Republican Party in the U.S. and recognized by them, and we represent the Republicans who live overseas, all Americans who live overseas, but we concern ourselves with the Republicans. And we are advocates for them to participate in the political system, to register to vote and to vote. We work to educate them on our candidates and our policies. And we also advocate to our politicians in Washington the I got to admit somebody here, the concerns of expatriates. Concerning the concerns of expatriates, today I wanted to announce, by the way, my name is Tony Rodriguez. I am the Vice President for Asia of Republicans Overseas. And I do want to thank you for coming today. We are announcing today that we have a new white paper for ending global taxation. And we're working with the Heritage Foundation and the Trump transition team to develop this paper, and it'll be published very soon. And Ken, I'll make sure you get a copy, and anyone on this seminar, if we have your email address, we'll make sure to get you copies as well. So with that, I'd like to turn over the microphone to Ken. Ken Guilfoyle is formerly a partner with BDO. He's been in Japan for 4 or 5 years now, this term, but 10 years overall. Previous to that, he was an adjunct professor with San Jose State University in global tax solutions. He was with AIG in Greece, in the US, and Japan. And previous to that was PwC as a manager for their global tax solutions in the UK and in Japan. And Ken, I really want to thank you for doing this seminar today, and it's such a busy time for you. And thank you for doing this. So over to you.
Well, thank you very much, Tony, and I appreciate the opportunity to speak to like-minded people and members of the Republican Party that are overseas. I've it's very hard to find what I would call like-minded people outside the United States sometimes, and it's always great to be a part of a diaspora of people who share similar ideas and values. So thank you so much for the opportunity. I am really happy to be here, and I'll start off with just saying, don't try this at home. My mouse died. Here we go. I got it. Got it back. Sorry, my mouse took a nap. Don't try this at home. I don't mean to say, like that I can't help you. I will help you if you want help, but if you listen to what I say today and you use it for your own benefit, then it's at your own risk. I have to do that. So look, I have what you should always remember is politicians write the tax law, and therefore they have an agenda, and their agenda gets contributed into the tax code. And so I have a point of view, just like many of others like you. And so if you'll hear my opinion, and if it matches with yours, great. If you think I'm off, well, then I'm off. But at least we're having a discussion about it, and this is an important topic which affects us all, because as Americans, we're all basically stuck with global taxation, double taxation. But then you have to figure out, by using the code, how to avoid the double taxation. So to kind of get started, this is a year where we don't have any COVID relief or any COVID or any of those weird problems out there. So everything's kind of back to normal. Your payment deadline is April 15th. Your filing deadline for those of you who are outside the U.S. on April 15th is June 17th. You have that automatic 2-month extension. And then if you need additional time, you can file Form 4868 and get an extension until October. And if you even want more time, you can actually extend until December by sending a letter to the IRS just requesting that you're entitled to the additional 2 months because you are outside the United States. So I always like to kind of survey the audience before I do a presentation because I want to know who's with me. I want to know about you, learn about what you're thinking, where you are in your career, etc. And what I found from the survey that I took before the presentation was the majority of the people on this presentation have lived outside the United States for 10 years, most of them even 20. So what you find there is the kind of the character of a person who, wants to spend their time outside the U.S. They want to maybe even retire outside the U.S., which is another question I wanted to ask. And most of the people that responded to the survey suggested they want to retire outside the U.S. So what you don't see is people with a clear no, right? There isn't that clear no, I have no intention to stay outside the U.S. I just want to stay outside, going to go back home or anything like that. No, they want to stay where they are, or maybe go somewhere else. A lot of the people that answered the survey were dual citizens and there were a few work permits, but primarily you had permanent residents and dual citizens. Again, what that tells me is long-term commitments to what you're doing outside the U.S. And for the most part, most everyone worked for a local entity, which also shows that the spirit of the times now is that if you are outside the U.S., it's harder to get the quote expatriate packages where you're getting, special benefits and housing and treatment and tax equalization. You're kind of stuck, managing your own affairs, which means you have to look after your own tax affairs. You have to look after your own future, and you have to manage the problems of dual taxation in terms of, I would love to have a pension in the foreign country where I live, but then when I'm I have to manage U.S. law, and there's an inefficiency between the opportunities. For example, like an IRA or a 401k in the U.S., that's not going to get the same tax efficiencies as a foreign plan and the like. So at least that gives me the chance to talk to you a little bit about how to consider these things or how to look at them. So, I'm a binary guy, and I don't believe that there's more than two genders or any of those kinds of things. So it tends to, when I look at these issues, what do you need to worry about in the tax realm? And there's basically 2 points. The first one is, well, it's better to comply, and if you don't comply, well, then they can penalize you, and that stinks because then they charge you additional penalties and interest for not complying properly. And then I guess the worst part is that if you're egregious about it, or if you take aggressive plans that aren't, capable or don't fit within the rules, well, then you can get thrown out the game, which basically means you could end up in prison. None of those things you want to happen. So you want to pay attention to what's going on in the tax realm. You want to take advice. You want to file. You want to comply. A lot of people get angry about that. We have to, file a return in the United States, even if we don't owe tax. But at least if you do, then the statute can close and off you can go. Now, we can all argue about whether this is good or bad or right or wrong, but at least at the moment, this is where we are. So why do you join the diaspora? Why do most people join the American diaspora outside the United States? And my answer is there are basically 2 reasons. We're back to the binary. The first one is employment, right? I mean, there's a job, there's an opportunity. It's the reason why I went to Japan. The first thought that I had was that maybe I could, do work that was different than what I would have done had I stayed in New Jersey. It's all part of the same process, but the opportunity is really what drives you, and then you get kind of hooked into it. When you get hooked into it, and as you go through your career, of course, what do? You become more valuable, you earn more money, and then what's next? Well, you invest. And investing is basically the second reason why people go outside the United States. Sometimes those opportunities are really interesting. There's like, for example, you could start your own business. You could operate outside the United States and have your own business and the like, and maybe that's a better opportunity than if you had stayed at home. But those are basically 2 reasons: employment and investment. So when we talk about tax planning, it's basically another binary point. It's either deferral or avoidance. Now, Deferral basically means, oh, I can pay the tax later. I can wait. I can have a recognition event but not have to be taxed until another point in time. Avoidance is the legal way of not having to pay at all, ever, at any time. So the best examples of this is, like, for example, the Roth IRA or a regular IRA. A regular IRA, I can contribute funds into. They can grow tax-free. And then maybe when I take the withdrawals in retirement, then I pay a tax on the distribution. And with any luck, right, during the course of my career, I've saved some money over time by contributing to the IRA. And then when I take the distribution at retirement, I take it at a lower tax rate because I'm retired, right? I don't have as much income in retirement as I did when I was, in my 50s working at the height of my career. That the second opportunity, let's say avoidance, is best described maybe with a Roth IRA. So the Roth IRA is I make the contribution, the investments grow tax-free, and then when I withdraw from the Roth IRA, I don't pay tax on that. So I get avoidance. So that's the gold standard, or the trophy of tax planning, is getting both deferral and avoidance. There's really only one vehicle under US law that allows that, which is a Roth IRA. So, of course, during life, there's a bit of stages that occur, and you leave the United States and you work for a while, and next thing you know, you meet that person and you become married, and then now you're dealing with the life stages as well as the tax issues that go along with them. Usually, again, your career goes up, you have the highest amount of income, that's when you generally pay the highest amount of tax in your middle age, and then it drops off as you go. But when you need the most money is when you have the most, sort of say, costs on yourself, and that's the life stage of children and the like, and that all puts the pieces of the puzzle together for most people. And when you do have children, you get deductions and dependents and things like that to go with it. So the first question that a lot of people might ask is, or that maybe they're interested, is, how do I file a joint return with my non-US person spouse? And the answer is you can't, unless you make an election. So under the Revenue Code, you can make an election to file a joint return with a non-resident alien spouse under 6013G. And effectively, all you're really saying is that my non-US person spouse wants to be a US person, and therefore we'll file together. If you don't make the election and you file a joint return, you're actually not doing it right. So you can stop doing that if you want to. But if you want to if you're going to, if your spouse is going to get a green card anyway, because you're going to go back to the United States at some point, or maybe during retirement, then fine. Why not make the election? Because you're just going to end up in the same place anyway. Now, to do that, the next part of this is that you can't file a U.S. tax return with a non-resident alien spouse unless they have an individual tax identification number. And that's actually a pain in the neck. But you have to have that in order to file a joint return. And what do you need to do to get one? You file this form, Form W-7, and you complete the form with the information required, and you check the box here, spouse of a U.S. citizen or resident alien. Now, getting an ITIN number is incredibly difficult. And it's been over my career, what I've seen people tell me is unbelievable stories about, well, I've been trying to get this ITIN for so many years, and I can't because, they got to have this or they got to have that, or I get certified documents from the embassies, and then when I file, they don't issue the number. So, in this person's case, they waited 3 years before they actually got the number to file a return. There is a solution. There are people throughout the world, and you can search on the IRS database and the IRS website for this. The people are called certified acceptance agents. These are people who've gone through the training to be able to to be able to help you get an ITIN number. And that person, you have to generally meet them face to face or through some kind of online procedure where they can look at your passport, they can verify that it's real, they can verify that you're real, that you're the same person, and then they sign the W-7 form, and from there, that W-7 form and your tax return can go to the IRS, and with any luck, it'll get processed and you'll get the ITIN. But it is a royal pain in the neck now to get one. Now, if you decide not to file a joint return with a foreign national spouse, then you have two choices. Back to the binary. Married filing separate or head of household. And you can't claim head of household unless you have children. So, and your children have to get Social Security numbers. So there's all that process involved in doing that. If they're born to U.S. citizen parents can transmit citizenship, then you can get all the paper and all the, you can get the Social Security number like at the embassy and do all the applications there, or the consulate. But in the end, you're stuck with the tax rates that go with marrying filing separately, which are basically single rates, unless you have children and unless you're willing to make the commitment to file a joint return with your spouse. So there are basically, as I said, two reasons why people come to or leave the United States, and the first one is employment. And so how do I avoid U.S. tax on employment income? And the answer is they offer the foreign earned income exclusion. Now, people often say things like, oh, the foreign income credit or the foreign credit for excluding, it's the foreign earned income exclusion, and they allow you to avoid tax on $120,000 during 2023. It goes up every year. Now, for example, because I'm in Japan and it's relevant, right? The exchange rates are kind of interesting. That's 16 million yen, which is pretty hefty or a pretty nice salary in a place like Japan, so that you can avoid tax just by claiming the exclusion. So how do you claim the exclusion? Well, you prepare Form 2555. And then, it asks you who you are, where you work, where you live, etc. Basic details, how long have you lived in the country? And that's the starting point. That's part one. To qualify for the foreign earned income exclusion, there are basically two tests. The first test is, are you a bona fide resident of the foreign country? And a bona fide resident of a foreign country is defined as someone who has lived outside the United States for one full calendar year. So in the year that you leave the United States, or maybe the year that you depart the United States, those are maybe a part year. So you generally can't claim the bona fide residence test. However, you can claim the physical presence test, which is the next opportunity or the next way to qualify for the exclusion. The physical presence test is that you have to be outside the United States 330 days in any 12-month period. So, for example, if you were outside the you came to the foreign country in July and you were there until the end of the year, you could get a 6-month exclusion as long as you wait to file your return until the next July. And it goes the other way too, in the year of departure. So the exclusion on a part year would be $60,000. People often ask questions about, well, if I go back to the US for 3 months, do I lose the exclusion? No, because your intention, your tax home, is still in the foreign country. Now, you can't claim an exclusion for foreign income for income that you earn in the United States, right? So you have to take that out of the picture. Any income you earn in the United States is going to be taxed in the United States. You can't get a tax credit. You can't claim an exclusion for income that's earned in the US. On the other hand, there's nothing preventing you from claiming the exclusion if you temporarily return to the United States. Now, a word of caution, and I like to share this with everyone. People who have green cards, United States green cards, who are residents outside the United States, it's not necessarily a problem for tax purposes. You get, as a permanent resident, as a green card holder in the United States, you get the same tax treatment as a citizen. The problem comes with immigration, in that if you state in a document that, yes, I'm a resident of the United States, but I live somewhere else, then immigration tends to get a little buggy about that. And they will ask you why. Maybe occasionally when you go home or through the, the immigration process in the United States, they'll ask you. So why bother give them anything to help? Just claim the physical presence test, and that's fine, right? If you claim that you're a bona fide resident, you're actually stating publicly or on a document that maybe you have a dual residency. So my income is more than $120,000. Now what? Well, you can claim a tax credit, and you can claim a tax credit on your U.S. return if you pay taxes, for example, on your employment income to a foreign country. Now, under U.S. rules, you're required to separate your income between employment income and investment income for purposes of claiming the tax credit. So you have to figure out, well, what is what? And maybe you have to do it under a pro rata, this income is related to this tax and that, et cetera, on a pro rata basis. Or if you're lucky, maybe there's a specific tax on a specific piece of income, like a withholding tax on a dividend. In either case, you claim the credit for on your employment income for anything that you earn over the foreign earned income exclusion. Now, this is what you do. You prepare this form, 1116, and on part 2, over here on the bottom corner is where you show the credit that you want to claim. And then the rest of the form basically carries you through, well, how much foreign income did you have? How much is over the exclusion? Then it gives you the pro rata basically the pro rata amount of tax credit on your return. And you should be able to avoid any tax in the United States thereafter. So, as I said, how do I avoid tax on employment income? Well, the first part is the foreign earned income exclusion. The second part is tax credits. So there's no such thing as double tax, and you should not be double taxed on employment income. Most taxes outside the United States are greater than U.S. tax, so you should be in a position to be able to get a tax credit if you are earning more than the exclusion. So now, the problem is investment, right? Because the point of the game is to make money. And once we make money, then we like to invest the money. And then that could end up being taxed in the foreign country. So what do I do now? Well, you can claim a tax credit on your investment income, as I said. So if you have income that's capital gain or dividend or the like, that goes in the passive basket, and you claim those taxes on the form here. Under certain conditions, for example, because you live in a country where your investment income is taxed, but it's also taxed in the United States and it's from a U.S. brokerage house, well, then you have a question of where's the source of the income? Because you can only get a tax credit if the income is sourced to the foreign country. And if it's a U.S. brokerage account, well, that's U.S. source. So under the treaty, under most countries where there is a treaty, Singapore, there's no treaty, Hong Kong, there's no treaty, but under countries where there is a treaty, you can source the income that's from the U.S. to the foreign country and claim the taxes that you paid in the foreign country. That is where this basket comes in right here, certain income resourced by treaty. It's good to check this because you're trying to avoid paying double tax. And that's the whole point of everything that we're here to talk about is avoiding double tax. If you are paying tax in the foreign country, you should be able to avoid U.S. tax by either the exclusion or the tax credit. Now, the problem is that in most foreign countries, the tax rates are higher. Most of the European countries, the tax rates are higher. Japan, the tax rates are higher. It's countries like Singapore, Hong Kong, and places like Hong Kong where the taxes are a little lower. And in that regard, well, then you end up paying higher tax. Wherever the higher tax is what you're going to pay. So if it turns out that you're in a place like Singapore or Hong Kong, and you only pay 15%, but your tax rate is 30%, then the other 15% you will pay or end up paying to the United States. And you'll have to make estimated payments to deal with it. So people often ask me, what is modified adjusted gross income? And this comes up a lot because, my kid wants to apply for financial aid at school, and I need to know, what is my modified adjusted gross income? Or I want to invest in a Roth, and what is my modified adjusted gross income? And it's really, really quite simple. It's adjusted gross income, which is basically the sum of your income plus the exclusion. And then you're back to adjusted gross income. Now, a lot of people would like to invest in a Roth IRA, but if you are married to a foreign national spouse, then you're doing married filing separate, and you're using married filing separately, then you can't generally get into a Roth because your income is too high. The limitation for MFS is $10,000. So what do? Well, under the regular Roth, the regular IRA rules, you can basically make a non-deductible contribution. You can make a non-deductible contribution almost at any time. You might not need the deduction in the first place. So what happens there? Well, I took the money I earned, it was taxed, I put it into the IRA, it's non-deductible, but I don't really need the deduction because I got the exclusion in a foreign tax credit. So I almost got the same thing as a Roth. I got 100% deferral, and I don't have the avoidance. Well, if I want the avoidance, then just do a backdoor Roth, right? And a backdoor Roth basically is I put the money into the regular IRA, I take the money out, I do the conversion to the Roth, I pay the penalty tax for the conversion, but now I've got the money in the Roth and I've got 100% deferral and 100% avoidance. Now, are you going to get are you going to get that efficiency in the foreign country? Maybe not. Was it worth it? Hard to say, but it's at least something you can do. So often people say, well, what happens if I start investing outside the United States? And that becomes a real interesting problem because the IRS's view is that if you invest in a mutual fund outside the United States, it's defined as a passive foreign investment company. And people often get really scared about this, but the truth is you can manage it. It's not that hard, but it's just another piece of the puzzle. Now, the problem with the PFIC is that you're back to choices. You can choose to do nothing, which means that I buy this investment and say at $100, and over the period of time that I held it, it goes to 1,000. Now I sell the investment. How am I taxed? Well, under the PFIC rules, because I didn't make any elections to do anything, I actually have to pay an interest charge for the deferral, and I get taxed at the highest marginal rate, which is currently 37%. So I don't get the capital gains tax treatment that I would really like to have. Instead, it's a flat tax at the highest marginal rate. So that's the punitive nature of investing in a mutual fund outside the United States for US tax purposes. You don't get the capital gains treatment, and you end up making adjustments to your basis, and you also have to pay the interest charge for the time that you didn't pay the tax. So you're back to binary choices. One, can I determine whether or not, or how can I determine what is the income that's generated from the fund? Meaning the interest and dividends that, or capital gain distributions that come from the fund, can I actually to figure out what those are and report them separately? And if I can, then I can make the election to treat it simply as a U.S. mutual fund. Because under U.S. rules, right, normal mutual funds, the interest, dividends, gain distributions, they're reported to you every year, you report them on your return. It's really simple. Under most foreign funds, they don't provide the information. So now you're stuck. So what's my other choice? Well, the other choice is a mark to market, meaning that at the beginning of the year it was worth 100. At the end of the year it was worth 200. I had $100 of unrealized gain. I elect to tax myself on the unrealized gain. I have to pay tax at regular ordinary marginal rates. It's no capital gain treatment. I get the capital gain treatment when I sell, but in between I don't. That's often sometimes painful for people, but it's the only option if you can't figure out what the income is. So that's it. Now, there's nothing scary about that. It's it's a series of choices. Which one do you want? Which poison do you prefer? The answer is, I would rather not do any of that. Then you can just go out and invest in foreign stocks straight up. No big deal. As long as you don't own more than 5% of the company, you can keep, own shares in Rio Tinto or whatever makes your fancy, and then sell those and get the same capital gain treatment as you would if you held General Electric. So somebody said this to me or asked me this the other day. They said, like, well, at the end of the day, shouldn't everyone just own their own company and run expenses through, so take as much as, minimize your taxation? And my answer is, yeah. However, I'd like to introduce you to Leona Helmsley. Now, she's kind of what I would call a relatively scary figure. And she was the hotel, queen of New York, maybe even before Trump came into the scene or, became even famous. But the problem that Leona Helmsley had was that she loved to take her personal expenses and run them through the company. She would run her underwear through it. And when she got audited and there was an adjustment, they came down on her pretty hard. So my answer to you is, sure, if you want to set up a company outside the United States, no problem. And I took Leona off the screen because I didn't think you want to look at her anymore. The point is, the company can be used to generate income, and you can spend, like, for example, in Japan, everything's 100% deductible. Entertainment expenses are 100% deductible, whereas in the US, they're not. There's 50%. So sure, if there's some reason for you to have a company outside the US and you're going to generate income and expenses to go with it, why not? The problem is that if you own a company outside the United States, you have to do a boatload of reporting to go with it. And a corporation typically is required that you have ownership of more than 50%, puts you into the category of a controlled foreign corporation, and therefore you're stuck reporting all of the performance of the company to the United States, and you might be subject to the GILTI rules, which basically forces you into a dividend every year. So it's a lot of work. There's more things to do. Is it a good thing? Yes. Is it a bad thing? Well, it just requires more reporting. And it's the same thing for a partnership. If you get involved in a foreign partnership, if you set up a corporation but decide to make the election to treat it as a disregarded entity, there's reporting requirements. If you transfer money outside the United States to a corporation, more than $100,000, there's reporting requirements. So at the end of the day, it's not, yes, there are good reasons to be self-employed and to use a corporation, because maybe you can pay your rent or things like that. And you can deduct the rent as part of the foreign earned income exclusion. But then again, you don't want to be Leona. So I just want to do a little bit about GILTI. If you do own a corporation, more than 50% and at least 10%, then GILTI is global intangible low taxed income. You're forced to take whatever the profit of the company is, you're forced to bring it into income. There are only 3 ways to avoid that. 1, the company's unprofitable. 2, you pay a dividend. Or 3, the corporate tax pays a corporate tax of more than 19.5%. Then you get a deferral. And we can get into this later, but it's maybe not terribly relevant to everyone, but that question has come up and I thought I'd address some of it. Now, don't forget the FBAR, the FinCEN, right? Having a bank account outside the United States greater than $10,000, and it's not just one, it's the accumulation of 10 or 5, whatever number of accounts you have. If it's more than 10,000, you have to report them to the government. That includes financial accounts like brokerage accounts, and I would suggest crypto as well. And so an interesting question came in at one point, like, well, how much information is my host country gathering on assets in the U.S. held by U.S. citizens, and are U.S. banks, IRS reporting information to the foreign government tax officials? Well, I've not seen that ever happen. Now, it doesn't mean it doesn't, maybe underhandedly, but I've never seen any real transfer of information by service providers or by banks to service providers between countries. There typically in treaty countries is a way for like the tax authorities in France to get information from the tax authorities in the United States. And they can make formal requests for that information through governmental protocols, but only at the governmental level. And given now European privacy legislation, I'd say that's even harder to do, because if you break any of the rules in Europe about the privacy legislation, you're going to jail for 300 years. It's good, it's also bad, but at least I've never seen any transfer of information between a bank and a government outside like a U.S. bank and a government, a foreign government, or the like. So the point of the game is to make money, and that's why most of us have our life the way we have it outside the United States. For some reason, we found that it was profitable. We developed some skills that made it good, and then now we're able to invest some of the funds. And as I said, the real problem here is who's got the higher tax. And, the tax planning point for any expatriate is to never pay more than you would have paid had you stayed at home. And right now, the highest marginal rate in the U.S. is 37%. So if you're able to do that in the foreign country, well, then you've done everything more or less that you could have done. Now, the current proposal, and they've been kicking this around for ages, is to push the rates back up to 39.6, but that still hasn't hit its day yet. And the last point I thought I would raise is that in case you haven't filed, or there's people out there that haven't filed or want to file or get back into compliance, then the offshore streamlined filing procedure is the best way to do it. 3 years of tax returns, 3 years of late returns, and then 6 years of the FBAR. So, for example, if you were like, well, I want to do that now, I would say, okay, you have an option. Wait until June 16th or June 18th. Then you're late for 2023. So then 23, 22, 21, and then 6 years of FBARs. So those 3 years plus the last three. And you can do that. Now, it's all filed on paper. I would recommend, and you also file a form that you basically say, gee, I'm so sorry, I made an inadvertent mistake. I didn't understand what I was doing, et cetera, et cetera. Can I please have a pass? And generally speaking, unless the IRS thinks you've done something or you've engaged in willful planning to not pay or to file in the U.S., then they'll leave you alone. You file the forms and you'll probably never hear another word about it. But it's the easiest and it's the best way right now to clean up anything like that. And then to go back into compliance, because once you've made the statement that, oh, I'm so sorry, I made a mistake, they're going to expect you to continue to remain compliant. So this is the point in the presentation where I like to kind of move away from those issues and kind of give people a little bit of insight into tax policy from my point of view, or what I see happening. And I do a lot of, the Tax Foundation is a really good source of information on tax policy issues in the United States and around the world. Now, it wasn't updated for 2024, and I don't know why, but I would like to show you, first of all, this is, I think, an important piece of information, right? Since 2017, basically 81% or more of the tax revenue in the United States comes from people. Now, I'll explain what I mean, right? Clearly, individual income taxes are from people. So that's 42%. Right? Social insurance, social taxes, Social Security, Medicare in the United States, payroll taxes are split 50-50 employer and employee. So the employee pays 11.9%. And consumption taxes are sales taxes, especially in the United States where we don't have a VAT. So most consumption taxes are what? Well, they're sales taxes paid by consumers at the retail outlet or in a retail setting. 16% of the collection's there. And property taxes generally are paid by individuals who own homes. Now, you could say, oh, well, businesses pay property taxes too, and maybe we should make some discount argument for that. But generally speaking, a business goes to a neighborhood in some jurisdiction, and the local jurisdiction say, well, you don't have to pay property taxes for 20 years. Well, then it's all being paid by the residents. Right? Now, why'd they do that? To generate employment. That's their goal. But 82% basically of the tax collections come from people, which means what is the policy? Well, since most people work, the policy is tax employment. It's simple as day. And it's one of the easiest ways for the IRS to collect tax because they withhold it from your paycheck every time you get paid, right? And then the rest of it comes out, as you said. I buy something at the store, I pay the consumption tax, and then I have to, I own this home, so I have to pay the property tax. It still comes out of the earnings. So I want you to see that perspective. Now, for 2025, the Biden administration, basically their proposal is what I call SALLY. SALLY stands for same as last year. There's nothing really exciting about what they're planning, other than a few things which I want to point out to those of us in the diaspora. And here's the first one. And they've been kicking around this out. They've been wanting to figure out a way that they can get a wealth tax in place forever. Now, this is the anti-wealth crowd running around Washington just can't seem to figure out how they can get their hands in other people's money, and they really want to figure it out. And so one of the things they've proposed is, a 25% billionaire tax, which is basically a tax on unrealized gains. Unrealized gains is really simply put, I had this stock, it was valued at 100, at the end of the year it was 200, so the government wants a 25% tax and I didn't sell the asset. It's like the worst of all worlds, right? Because, I have to pay the 25% tax, but I don't have the cash to pay it. Now, strangely enough, when you look at the statistics, right, high income taxpayers in the United States, let's say the top 1%, their average tax rate is 26%. So I don't know about you, and maybe it's just a coincidence, but it seems to me that this is just an airy-fairy idea of trying to keep that 25% or increase it. The idea of taxing unrealized gains is really, really difficult to figure out because what are you going to, is it just going to be on stocks and bonds and securities, or is it going to be on stocks, bonds, real estate? How do I value the real estate? Gee, we saw that Trump got a lot of trouble with valuing real estate. I mean, could you think of anything else to do? No. So this, as you can tell, I think this is a stupid idea, but yet they just can't seem to figure out how to get their hands out of the wealth of Americans. Now, here's the other one that I think affects the diaspora the most, and it's the net investment income tax. Now, if you have been investing, right, you get hit with, so I paid, I have a capital gain transaction. I pay tax in the foreign country. I claim my credit in the U.S. Good, everything's clean. But I end up paying 3.8% on the gain to the United States under the net investment income tax. It's the Obamacare tax. It's the social tax. So I was not allowed to claim a foreign tax credit against this tax. So it's just, I would end up paying this additional tax to the United States if I had, investment income. They want to raise that from 3.8% to 5% on income over 400,000. Currently, it's income over 200 if you're single, 250 if you're married. I could say that's probably going to capture some of us because, it's the way the markets are available or going. Maybe you might get caught up in some of these gain transactions and then you end up paying a little bit higher. But they also want to increase, as I mentioned, they can't keep their hands off of this one. They want to go back to 39.6% on income over 400,000 for a single filer and 450 for a joint filer. Now, okay, so if I did earn that amount in Japan, I'd end up paying 50% anyway. So again, I paid more in the foreign country than I did in the US. Now, here's the fun stuff. There was a court case about the net investment income tax. And it kind of went between the appeals and the like, but on January 12th, 2024, it finally got settled, and it's Christensen versus the United States. And effectively what happened is a taxpayer in France argued that the wording in the treaty about the claiming of a tax credit allowed them to get a credit for the net investment income tax. And it's these specific words here, provisions and limitations. In one clause of the treaty it had it, in the other clause it didn't. And then the court said, well, that means under the didn't, you can claim a tax credit for the net investment income tax, and then you don't have to pay it. My problem is that this is particularly difficult to do in other countries because the French-US treaty is really simple and it's very old. It hasn't been changed. If you read the US-Japan treaty, the US-UK, or any of these other countries, the wording is not as simple, and therefore it's much harder to figure out whether or not you qualify to get this credit. So what's the upside? Well, I mean, you can claim it. It's a 50-50 guess, and I think you need to be careful. Because unless it's the French treaty, which is a slam dunk, then you're taking a little bit of risk. Okay, so this is something I want to show you. And this is something I've been, when I mention the question about central bank digital currency, here's where I think it's worth talking about. So if you look at this is again Tax Foundation statistics. Right? The OECD countries, which the US, Japan, and most of the industrialized world is a part of, what they show in this chart is that consumption taxes are the most important tax revenue source of OECD countries. Consumption taxes, sales taxes, VAT taxes, collection at point of sale tax. In this pie chart, it's 31%. And if you look at it here, they'll say, oh, social insurance and consumption taxes are the more relevant than in 1990. So again, there's a greater level of consumption taxes being withheld now than in the past. And the drift towards consumption tax kind of has a purpose. It's easier to collect. It doesn't require as much enforcement. I mean, your sales are your sales, and if you don't collect it, well, then they hit you for it, right? You pay it. So chances are most retailers just collect it anyway, and it's very simple, right? I mean, is it a service, or is it a product? And if it's a product, it's always consumption taxed. Now, like for example, in Japan, services are consumption taxed. So it's a very simple way to get taxed, and it's a very easy way to get taxed, and it solves a problem. Now, let's look at this problem. Like this is the deficit. This is basically the deficit of the U.S. government, or deficit spending, right, between 2022 and 2023. And what happens is when income goes down, right, the tax collections go down, so the deficit goes up. And that's what you saw between 22 and 2023. And I'll just point it out again, right? The deficit in 2022, 1.38 trillion and 1.7 trillion in 2023, right? Tax revenue down compared to the prior year. Spending, of course, doesn't change. They can't stop spending, but they have a problem in this they have to fill this gap. And I think the only way they're going to fill this gap is through consumption taxes. Now, this is, again, from the Google machine, right? The U.S. economy GDP in 2021 was 23 trillion. And the debt, I took this picture from the debt clock, on Wednesday when I did this slide, right? It's 34 trillion. So the IMF says, it's 121% of GDP, but do the math, it's more like 130, right? And tax revenue to GDP is 16%. So you're kind of stuck with, well, what are they going to do to fix this problem? And this is the IRS's data book. In the IRS's data book, 2012 to 2021, individual income tax and estate and trust tax, right, basically again paid by people, total collections 2.5 trillion. And this is the same one, 2013 to 2022. It's just close to 3 trillion, but the slope is increasing. And so this is where I think we run into this problem, right? Because they either have to pay the debt or they have to inflate the debt. And there's a lot of evidence to suggest that they're inflating the debt, and that you're feeling it, I'm feeling it, we all feel it because, well, things cost more and we don't know why. So they're just printing more money. And so Executive Order 14067 basically creates the opportunity for the federal government to create FedCoin. FedCoin is a cryptocurrency. It's a cryptocurrency like Bitcoin or Ethereum, except that Bitcoin and Ethereum are decentralized, meaning that there isn't one person or one place that controls the issuance of the money, but FedCoin is clearly going to be a centralized network, and they can control and do whatever they want with it, which means that it's programmable money. And what can you do with programmable money? Well, you can put programs in the code that take a tax on every transaction. So every time I buy something, every time I pay somebody, there's a 1%, 2%, 3% tax. And if they can get people to transition into programmable money, then they can collect that consumption tax really, really simply, because it just goes straight to the treasury, right? And they have a problem, $34 trillion problem. What and how will they solve it? Look at this and think to yourself, well, gee, the technology is now available for them to unload this onto us. But politically, it's difficult to unload. Why? Well, most of us look at it and go, gee, the Canadian truckers, well, they got sucked into a real headache. They protested their government and they got debanked. Why would we allow the Fed to do the same thing to us? And the answer is because they can do away with the income tax. Because clearly, right, there's no need to have an income tax if you can consumption tax 1% of $23 trillion in GDP. You can collect a boatload of money on consumption tax on every trade, every transaction that happens by using FedCoin or using programmable money or the US dollar, crypto, or whatever you want to call it. And so that's where I think it also takes away my job because, there's no need for me anymore if people don't have to file income tax returns, which I understand, and maybe I should be looking out for a new job. But the key here is that this is on the horizon. And if people think that AI is going to turn over the world in the next 5 years, well, this is coming with it. And you should be ready. And with that, I end my presentation. So it's been a long, windy road, and thank you all for joining and listening to me. And I have a little time, so if people want to ask some questions, I think.
Okay. Thank you, Ken. Thank you very much. This is Tony Rodriguez from Republicans Overseas. Thank you very much, Ken, for the great presentation. And if anyone would like to ask questions, you can either text them into the chat function, or you can unmute yourself and go ahead and ask Ken. Is there anybody who has any questions? I know there's a hand-raising function somewhere in Zoom, but I'm not a Zoom expert, although I use Zoom all the time. You can also text questions to me in the meeting chat group. I'm monitoring that.
Could I just unmute potentially and ask a question?
Yeah, yes. Why not?
Okay. Hi, Ted Kempster, Austria. Submitted this prior to the meeting, but just as I'm reaching my mid to late 50s, thinking more about what the tax implications are going to be about Social Security income and other U.S. Like 401k withdrawals. Obviously, you can't speak to what Austria is going to do with that, but what are the implications? What are my options in terms of minimizing my tax exposure in the U.S.?
So what I'm going to suggest to you is a general thought, because I am not that familiar with Austria and the rules and the like. So you are a resident of Austria. They have the right to tax you because you live there. So any income, generally speaking, they will want to tax. So that includes Social Security, that includes the distributions from your IRA, your pension, or whatever. Now, can you pay or can you avoid U.S. tax? Of course you can. If the foreign country does tax you, well, the first thing is there's the treaty, and there's a treaty with Austria. And so you can claim a tax credit. You can claim a tax credit for the income that was paid by Social Security. Now, there is an exemption, typically speaking, in the treaty for Social Security. So if it is taxed by the foreign country, you can claim under the treaty that it is exempt from taxation in the United States. Now, I'm speaking in general terms. I don't actually know. I haven't read the U.S.-Austria treaty. But in general, you end up in the same place. You are taxed in the country where you are resident.
Thank you.
question that is kind of related. Well, it is related to Social Security. I don't know if it's a accounting question, but it's what it is I'm 63, so I'm actually legally qualified for Social Security at 62, I believe, or for early. But I'm advised to wait until I'm 70, and I'll get more money per month. But I've also read that the Social Security fund is supposed to have a huge 25% cut, like I think in 2027, 2028, because the monies won't cover it. Is there have accountants started talking to people and advising them on maybe the normal strategy on Social Security, and waiting is not actually a good idea?
Yeah, that's a great question. And I would say that the industry of financial planners and typical accounting tax advisors will always use what they know, and what they know is what's available right now. And what's available right now is that, if you wait till 70, you'll get more. On the other hand, money today is better than money tomorrow. And maybe money is never coming tomorrow, which is your point. And so, do I have a good answer on this? No, because the political tea leaves are way too difficult. Although I have heard people like President Trump and others basically say, Social Security is off limits. So let us hope that it stays that way. And if it does, then yeah, waiting till 70 is a better answer.
Thank you.
I mean, that I should also preface that with, that means you have the resources to sustain yourself until 70.
Hopefully so.
Yes, right? Hopefully so.
Any other questions? Okay, well, we're up to an hour now, so I'm going to say thank you very much, Ken, for doing the presentation.
Thank you.
I'd also like to thank. Thank you, Ken. I'd also like to thank Lance Gatling. Lance, I believe, is still on the call. Lance helped to set this up. I see Lance's iPhone 8 now in front of me.
My mentor.
Thank you very much, Lance. Lance is our chairman for Republicans Overseas in Japan, and I am head of the VP for Asia, but I'm also head of Thailand. So if you have any questions or would like to know more about Republicans Overseas, please contact Lance Gatling in Japan or Tony Rodriguez here in Thailand if you're in Asia. Ted is also on a call, and he's in Austria, I know. And Mark Crawford, I see him, he's in Albania. So anybody interested in Republicans Overseas? Hello?
Yeah, hi, this is Lance. One thing, Ken, I had to fumble with my audio, sorry. There's a new reporting requirement. You mentioned the FinCEN.
Yeah.
There's a new reporting requirement that's going to hit everybody that has
Yeah, I didn't.
either a sole proprietorship or.
That's a great point. This is
a kind of a nightmare. I mean, it's a really draconian rule. Can you explain that and what that has to do and our financial planner? Who's dealing with this?
So I can talk to it in a general sense because it's still currently under judicial review. Effectively, right, there on one of the pieces of legislation that popped up a couple of years ago, starting in the beginning of this year, if you are the beneficial owner of a corporation outside the U.S. or if you are a foreigner who is the beneficial owner of a corporation in the U.S., you're required to disclose that ownership with the Treasury. And it's basically the same as a FinCEN type reporting. Now, there was a court case that came up with this, I think it was in Texas, where the court held it was unconstitutional. Then, of course, they went to appeals. The appeal is probably not going to get settled until later this year. And if it, so I would say, or I would recommend that you be prepared to make the disclosures. And it's clearly what's the name of the company? Where is it located? Who owns it? Things like that. By the end of the year, because the reporting deadline is the end of the year. So you have a little bit of time, and hopefully, with any luck, maybe the appeal is the IRS's appeal won't be held, and that the lower court will be, lower court opinion that it's unconstitutional will be held. But I'm not holding my breath. But it is right. Exactly what you said. It is a new reporting requirement under the FinCEN rules that requires an owner of a corporation to disclose who the beneficial owners, like who the shareholders are.
And the beneficial owners, if I understand it correctly, include people like managing partners, directors of
Yes.
the company, named
Yes.
officers.
Yes, correct. Yes.
And I've been talking about this with a bunch of guys who have businesses overseas, and they're at full tilt, at full swing. This thing is supposed to be like updated within 90 days of you moving.
Yes.
So you make a report of
Yes.
your even your
The first
soul is.
The first reporting
Go ahead.
requirement is this year, and then thereafter, if you make a change, it has to be reported within 90 days.
90 days. So, and that includes even if you move your apartment or change your email or something, you got to report that to the U.S. Treasury within 90 days of the change.
As the rules are written now.
Yeah. Wow. And it's beneficial owners, not 51% owner. It's anybody that has substantive control of a business entity or a bank account.
Correct. Correct.
That's a big deal, right? I mean,
I'm not
this is
denying that
hundreds
at
of
all.
millions
And
of-
yeah, it's, I mean, I just didn't bring it up because it's still under review, but
Yeah.
but yeah, it's
Well, maybe we'll have a discussion of that later in the year as this thing clears up a little bit more. Because I understand that the Texas court is going to be overturned. The
Yeah,
expectation is they're going to be overturned.
yeah, it wouldn't surprise me.
Yeah. Okay. Anyway, thanks, and thanks for the nice words, Tony. Yeah. Anybody wants to talk about Republicans in Japan? Let me know.
Okay, thank you,
No.
Lance. Any other questions on this tax subject?
Is this going to be recorded and put on online?
Yes, I'm actually in a studio right now. We're recording it, and we will post it on YouTube at some point. And of course, I can share it with the group, the Republican Abroad group. They can put it on their website if they want. Whatever works for you guys.
Please do.
Yeah.
We'd love to do so. Well, thanks much, Ken.
Oh, my pleasure.
Together, guys.
Thank you very much. Okay, everybody, bye-bye. Thank you.
Thank you. Nice talking to you guys. See you.
Bye now. Bye.